Like if you look at some technology businesses, they start off looking like technology businesses, and what they really are tech-enabled consumer businesses. Other businesses are pure technology companies. And why that distinction is important in this context is that there are certain kinds of challenges you have in the former that you just don't have in the latter, and vice versa. So if you're a Google or a Facebook and you run into some problem, typically the solution is you can engineer around it, because ultimately your product is free and there's a different way to scale and grow and create feature value, because those are also incrementally free. If you look at a company like Airbnb, and if you look at the last 6 months in the stock, what is it telling you? It's telling you that the people that own it have realized that it's less of a technology business and it's more of a cyclical business that ebbs and flows with the ability to spend money on behalf of the consumer. So now all of a sudden you're put into a different bucket and you grow as people's belief ebbs and flows about the amount of spending that consumers have. That is independent of your product quality. And what that means is that there's no amount of investment in technology that you can really make to change that. People need to have excess capital in order to spend on vacations, and then you can capture your fair share of that. But if we're in a recession, that company will be under pressure in a way that has nothing to do with the internal product quality that they exhibit. So these are just dimensionality. It's just different kinds of problems that every single company faces that are totally unique to its own circumstances. So if you are trying to point to some label as the reason why your company is failing, I would just encourage you to not do it.